Welcome to Inside Corporate Finance, your go-to podcast for decoding the financial world. Before we dive in, make sure to follow us, share this episode with your friends, and if you want to reach out, send us an email at insidecorporatefinance@gmail.com. If you're looking for expert insights on corporate finance, treasury, derivatives, funds, the stock market, and cutting-edge financial technology, you're in the right place. Here, we don't just talk numbers. We break down the trends, the risks, and the opportunities shaping the global economy. Whether you're a finance professional, an investor, or simply passionate about the markets, this is where you stay ahead. So grab your coffee, plug in your headphones, and let's dive into the strategies and stories that drive the financial world forward. This is Inside Corporate Finance, where money meets strategy.
Ever feel like you're missing some kind of secret decoder ring when it comes to understanding financial reports?
You're definitely not alone there.
Yeah.
A lot of people, even people who follow the markets pretty closely, they get intimidated by these reports.
Yeah.
But that's why we're doing this deep dive today, to give you the tools to analyze companies like a pro,
Right.
like a real expert would.
Yeah, totally.
And, the interesting thing is, once you know how to read these reports, it's like they become these treasure maps,
Right.
They can reveal a company's hidden strengths
Yeah.
and their weaknesses.
I like that. Okay, so let's break out the shovels and start digging. Our guide for this little expedition is the Merrill Lynch Guide to Understanding Financial Reports.
Great guide.
And trust me, you don't need an accounting degree or anything to follow along.
Absolutely not.
Yeah.
No. Whether you're, an experienced investor or just starting out, understanding these reports is key.
Yeah.
It's key to making informed decisions
Absolutely.
with your money.
Yeah, for sure. So the guide starts by laying out the 4 key financial statements that you'll find in a typical corporate report. They call these the Big 4.
Right?
And it's like having 4 pieces of a puzzle. Each one tells part of the story, but together they reveal the whole picture of a company's financial health.
Exactly. And the first piece of that puzzle is the balance sheet. Just imagine it as a snapshot, frozen in time, of what a company owns and what it owes at a specific moment.
So it's kind of like taking inventory. We're figuring out what's in the company's treasure chest and who they might owe some gold to.
Exactly. And that treasure that you're talking about, that is the company's assets.
Right.
And that can be things that are easily turned into cash, like money in the bank, for example, or payments that they're waiting on from customers.
Right.
Those are considered assets.
So the guide uses this fictional company called ABC Manufacturing
as an example. And they say they've got $405.8 million in these easily accessible assets, up from the year before. So does that mean they're sitting pretty? Is that good?
Well, it's a good sign.
Yeah.
Generally speaking, a higher amount of assets indicates that a company has more liquid resources to work with.
All right. The more cash is usually good. That makes sense. What about the stuff a company owns? That's not as easy to just turn into cash, like their factories.
Oh.
Or their equipment.
Yeah, those are called fixed assets. Those are the things they use for the long haul, for years, hopefully. And there's a little catch here. These fixed assets are listed at their original cost, not their current market value. So that, shiny new factory that they bought a few years ago, it might actually be worth a lot more today. Or, maybe it's depreciated in value.
Yeah, it's like buying a vintage car.
Right.
It could appreciate in value over time, or it could turn into a rusty clunker.
Exactly.
Yeah.
Exactly. And then there are these things like patents.
Or a company's reputation. Those things have value too, right?
Well, yeah, for sure. I mean, can you imagine trying to calculate the value of a brand like Apple or something? It's not just their, physical products. It's the design, the innovation, their image.
You're right. Those are called intangible assets.
Yeah.
And they don't have a physical form, right?
Right. Yeah.
But they can be worth a lot. They can make up a huge part of a company's value. Think about a popular social media platform. Their user base is a massive intangible asset.
Yeah.
It's worth a lot of money.
Makes sense. But how do you measure the value of those things? That seems really hard.
It's not as easy. You can't just go out and appraise it the way you would appraise a building. It's something that analysts spend a lot of time trying to figure out.
Yeah. Okay, so that's the asset side of the balance sheet. Now, what about what a company owes.
Right.
Their liabilities.
Yeah, think of those as the bills
Yeah.
that need to be paid. And just like with the assets, these liabilities are split into two categories. The ones that need to be settled quickly, within a year, and the ones that are stretched out over a longer period.
So it's like the difference between your credit card bill that's due next month and your 30-year mortgage.
Exactly.
Yeah.
And just like people, companies can take on a lot of debt to fuel their business.
I'm guessing that can get pretty risky if they can't keep up with the payments.
It can. It can definitely be risky.
Yeah.
It's called being highly leveraged. And while it can accelerate growth. You know, it can make a company grow more quickly. It also increases the risk if those interest payments end up eating into the profits.
Right. Yeah. Makes sense. Okay, so once once you've got a handle on the company's assets and liabilities, then you subtract the stuff they owe.
From the stuff they own.
And that's where you get to the shareholders' equity.
Right. That's it. That's how it works. Shareholders' equity represents the owner's stake in the company. It's essentially what's left over for them after all the debts are paid.
So, like, if the company suddenly vanished and everything had to be, like, liquidated, that's what would be split up amongst the shareholders.
Got it. That's the basic concept. Now, this equity can be in different forms, like, preferred stock, for example, common stock. And then there's something called retained earnings.
Retained earnings.
Yeah. You ever heard of that?
I'm not sure.
Retained earnings it's basically the accumulated profits that a company has decided to plow back into the business rather than pay out to shareholders as dividends.
So it's like a savings account for the company.
Yeah, think of it like that, a
fair.
savings account for future growth.
Gotcha. So like for ABC Manufacturing, their shareholder equity was $346 million, largely because of those are reinvested profits. That's a good thing, right?
Absolutely. That's a very good sign. It shows that they're not just focused on short-term gains, but that they're actually investing in their future.
Makes sense. Okay, so we've tackled the balance sheet, which is our first piece of the financial puzzle.
Right.
Now, how do we actually see how a company performed over time?
That's where the income statement comes in. Think of it as the company's report card, showing how much profit or loss they generated over a specific time frame.
So it's like comparing what they brought in with what they spent, and seeing if they aced the test, or if they need some like serious tutoring.
Precisely. And it all starts with their net sales, which is basically the total revenue from selling whatever goods or services that they offer.
So for a company like ABC Manufacturing, it would be the total value of like all the widgets they sold.
Right, all the widgets, exactly.
Yeah.
From there, we subtract the cost of sales, right, which is basically all the expenses that are directly tied to producing those widgets. Raw materials, labor, manufacturing costs.
So what it actually costs them to create the stuff.
Exactly.
Okay.
Once we take that away from the net sales, then we get the gross margin.
Okay.
And this gives us our first glimpse into the company's profitability, it tells us. How much money they're making from each widget before we factor in all the other costs of running the business.
So the guide says that ABC Manufacturing's their gross margin percentage jumped from 30% to 32% in the year we're looking at. Does that mean they're getting better at making widgets? Is that what that means?
Well, it could be a couple of things. It could mean that they're becoming more efficient at managing their production costs. Or they could have been successful at raising prices.
Oh, okay.
Either way, it's a positive trend.
Okay.
Consistently rising gross margin often signals that a company is becoming more profitable in its core business operations.
Okay.
So that's a good sign.
Okay, so even a small change in that percentage can tell us a lot.
It can. It's like a clue. That hints at how well a company is running, that core business. Now, from there, we need to factor in all those other costs of running the business. Things like salaries, marketing, rent, all the day-to-day expenses.
So it's not just about making the product, but also getting it out into the world and convincing people to buy it.
Exactly. And all of those costs, those are called operating expenses. And once we subtract those from the gross margin, then we get what's called operating income.
Okay. That sounds pretty important.
It is.
Yeah.
Operating income is. It's crucial.
Yeah.
For gauging how well the business itself is actually doing. Before we start factoring in things like taxes or any one-time events,
Okay.
it gives us a clearer picture of the company's core profitability.
The guide mentions something called extraordinary items on the income statement. What are those?
Those are the curveballs that life throws at businesses. Things like earthquakes, lawsuits,
Yeah.
events that are, outside the normal course of operations. And they're reported separately. So they don't distort the regular picture of profitability.
So it's like saying, okay, this was a fluke event.
Right.
But let's look at how the business normally is performing.
That's the idea.
Okay.
Now, there's another crucial piece of the income statement puzzle. Earnings per share, or EPS. Ever heard of that?
Yeah, I've heard of that. I always hear about that, but I'm not always sure I, totally understand what it means.
Right. EPS is basically how much profit each share of common stock earned.
Okay.
Think of it this way. If the company took all of its profits and divided them equally among all of the shares of stock, EPS tells you how much each share would get.
Oh.
Does that make sense?
So it's like a way to see how much profit one single share of stock is actually generating.
Exactly. And that's a key indicator, right, of
Yeah.
how valuable the company is to its investors.
Yeah, right. Okay, so in ABC's case, their EPS grew from $2.77 to $3.21. So I'm assuming that's good.
That's a nice bump for the shareholders.
Yeah, but they were pretty happy about that. So rising EPS is generally a good sign, but I'm assuming there are cases where it's not, like the whole story.
You're right. Savvy investors
Yeah.
always dig deeper. You want to understand what's driving that EPS growth?
Yeah.
Is it sustainable growth, or is it the result of some kind of one-time event, or maybe even accounting tricks?
Oh, okay.
So you got to be careful.
So we need to be a little bit like financial detectives here.
Exactly.
Looking for clues.
Got it. And that brings us to
Okay.
our next financial statement. The statement of cash flows, this one, is all about tracking the actual movement of cash, where it came from and where it went.
So it's like following the money trail.
Exactly. Seeing the flow of funds in and out of the business. It's like a financial map charting the course of a company's cash. And it breaks down that movement into three main categories. Cash from operating activities, cash from investing activities, and cash from financing activities.
Okay, break that down for me. What are those three things? What falls under each one?
All right. Well, operating activities those are the core business transactions.
Okay.
Things like collecting payments from customers, paying salaries, buying supplies, the day-to-day stuff.
Right, okay.
Investing activities. That involves putting money into things that will help the business grow in the long term.
So things like buying new equipment or maybe acquiring another company.
Exactly. It's about making strategic investments for the future. And finally, financing activities deal with how a company raises capital. This could be taking out loans, issuing bonds, or selling shares of stock.
So it's how they get the money they need to fuel all those operating and investing activities?
Exactly. It's all connected.
Yeah. And looking back at ABC Manufacturing, the guide says they spent a pretty decent amount on new fixed assets, even though it meant they had less cash on hand in the short term.
Right, and that's a really important point. Sometimes a decrease in cash flow can actually be a good thing.
Oh.
In ABC's case, it suggests that they're confident about their future and they're making investments to expand the business.
Right. So it's not always about hoarding cash, but using it strategically to grow.
You got it. Managing cash flow effectively, it's like making sure the lifeblood of the business is circulating properly. Even a profitable company can get into trouble if it doesn't manage its cash wisely.
Yeah, that makes sense. So just like in our personal lives, it's not just about what you earn, but how well you manage your money.
Exactly.
Okay, so we've covered the balance sheet, we've covered the income statement, we've covered the statement of cash flows. What's the final financial statement we need to unravel to complete our little detective work here?
That would be the statement of changes in shareholders' equity.
Okay.
This statement breaks down how the ownership structure of the company has changed over time. It's like a pie chart showing how the slices of ownership are divided and redivided.
Okay. So it's not just about how much profit the company made, but who owns the company and how those percentages have shifted.
That's right. It tracks things like profits, dividends paid out to shareholders,
Yeah.
and the issuance of new stock.
So for ABC Manufacturing, what clues does this statement reveal?
Well, it shows that they issued additional common stock during the year.
Oh, okay.
Most likely to raise capital for those expansion plans we talked about.
Mm-hmm.
They're bringing in new investors
Mm-hmm.
and giving them a piece of the pie, which could be a smart move if they're confident about future growth.
So it's like they're baking a bigger pie and inviting more people to the feast.
I like that analogy.
Yeah.
Now, this statement also provides valuable insights into things like dividend payout percentage,
Okay.
dividend yield, and return on equity,
Mm-hmm.
or ROE. These are key factors for investors who are looking for both income and growth.
Okay. Remind me what those first two are. Like, what do those terms actually mean?
Sure.
For someone trying to assess a company's performance?
So, dividend payout percentage tells you what portion of a company's earnings is being paid out to shareholders
Okay.
as dividends. It's a percentage.
Okay.
So it shows you how much of the profit is being shared directly with the owners. Dividend yield,
Mm-hmm.
on the other hand, is it's the annual dividend payment as a percentage of the stock price.
So it's like a way to compare the dividend income you'd get from earning a stock with the price you paid for that stock.
Exactly. And if you're an income-focused investor, dividend yield can be, it can be really important
Got it.
for making your decisions.
Right. Okay. And then ROE, we talked about that a little bit earlier when we were talking about shareholder equity.
Right.
What makes that such an important metric for investors? Remind me.
Return on equity is.
Mm-hmm.
It's a powerful measure of how effectively a company is using its shareholders' investments to generate profit. Shows how much profit a company generates for every dollar of shareholder equity.
So it's like a report card for management?
Yeah.
Like, how well are they using the shareholders' money to make returns?
That's a great way to put it. A high ROE suggests that the company is a good steward of its capital and that they're creating value for their shareholders, which is a good thing.
Yeah. And in ABC's case, we see that their shareholders' equity grew to $346 million.
Right.
Which I'm assuming is a good indication that they're using those investments wisely to drive growth.
It is.
Okay, great. So we've now covered the four major financial statements.
Yeah.
The balance sheet, income statement, statement of cash flows, and statement of changes in shareholders' equity.
We've been busy.
Yeah, I feel like we've just run a financial marathon here.
You've done great, though. We've covered a lot of ground. But there's one more important section in a corporate report that we should probably talk about before we move on. And those are the notes.
The notes, aren't those just like just kind of boring details and fine print that everyone kind of skips over?
You'd be surprised. The notes often contain really crucial information that isn't directly included in the main financial statements.
Okay.
They can provide context, they can clarify certain accounting practices, and they can even highlight potential risks. It's like reading between the lines to get the full story.
Okay, what kind of like juicy details might we find tucked away in the notes?
Well, the notes can contain a lot of information, like the company's accounting policies.
Okay.
How they calculate things like, depreciation or inventory valuation.
Yeah.
Details about how they manage their taxes. It's a bit technical, but it can be really important for understanding the company's true financial picture.
So it's like understanding the rules of the game.
Yeah.
The notes explain how the company's keeping score.
Exactly. And the notes can also reveal information about potential lawsuits or other liabilities that might not be directly reflected on the balance sheet. These are called contingent liabilities.
Okay.
And they can sometimes be a bit of a red flag for investors.
So the notes can definitely reveal some skeletons in the closet.
Well, not always skeletons.
Yeah.
But definitely things that investors should be aware of. The notes can also provide valuable insight into a company's segment performance. This is particularly relevant for diversified companies that operate in multiple industries.
Oh, so if a company sells everything from cars to clothing, the notes would kind of break down how each of those divisions are performing.
Exactly. It's a way to see which parts of the business are thriving and which parts might be, struggling.
Wow.
You might discover that, Even though a company's overall numbers look good, one of their key divisions is actually losing money.
So it's like peeling back the layers of an onion. The notes can reveal like a whole other dimension to the company's financial story.
You got it. And speaking of revealing important information, there's another crucial part of the report, the auditor's opinion. Familiar with that?
Yeah, remind me what the auditor's opinion is all about.
The auditor's opinion is essentially a seal of approval.
Okay.
Or not, from an independent accounting firm. That's reviewed the company's financial statements. They're the ones checking to make sure that the numbers are accurate and that the company is following generally accepted accounting principles, or GAAP.
So it's like having a financial referee making sure the company is playing by the rules.
That's a great way to put it. And the best case scenario is what's called an unqualified opinion, meaning they've given the company a clean bill of health. But if the auditor's opinion is qualified, meaning they have some concerns or reservations, that's definitely a red flag.
Okay.
You need to investigate further.
So if you see a qualified opinion, it's like the referee throwing a penalty flag.
Exactly.
You need to like pay attention and see what went wrong. What else should investors be looking for in the auditor's opinion?
Even if the opinion is unqualified, the auditor might include a separate paragraph called an emphasis of matter, highlighting something specific that investors should be aware of. It's like saying, hey, everything looks good overall, but keep an eye on this one thing.
Okay, so reading the auditor's opinion carefully is like getting some insider information from the financial referee. Now, before we move on to the next part of our deep dive, I'm wondering about this whole idea of like financial intuition. Like I get that we can, learn all these ratios and the techniques, but is there a way to develop a gut feeling for what's normal and what might be like a red flag?
That's a great question. And you're right. It's not just about crunching numbers. It's about developing a sense of what those numbers actually mean.
Right. So how do we go from being financial, newbies to being like seasoned financial detectives?
Well, one of the best ways to develop that financial intuition is through practice. The more you look at real world financial reports, the more you'll start to see patterns.
Okay.
And get a feel for what's typical for different industries.
So it's like learning a new language. The more you immerse yourself, the more fluent you become.
Exactly.
Yeah.
And don't be afraid to. Don't be afraid to ask questions if something seems off or it doesn't make sense. Dig deeper. There are tons of resources available. Analysts' reports, industry publications, even online forums where you can learn from other investors and really develop your understanding.
Oh, I like that. It's like joining a community of financial detectives all working together to crack the code.
It's a great way to think about it. Now, are you ready to take everything we've learned about these 4 major financial statements and start applying it to real world scenarios?
I'm ready. Let's do it. I'm feeling much more confident about navigating this whole financial landscape. Let's fire up those detective brains and see what mysteries we can solve.
All right, let's do it.
All right. So we've laid the groundwork with those 4 main financial statements, but I'm ready to go full on Sherlock Holmes here.
Yeah.
Are there any specific techniques that analysts use to really kind of like get under the hood of these reports?
You're speaking my language. One of the most powerful tools in a financial analyst's arsenal is ratios. They're like those magnifying glasses that detectives use to find the hidden clues.
Oh, I love a good ratio. Yeah. It's like a secret formula for like unlocking these hidden insights.
Exactly.
Where do we start?
Let's begin with one that's fundamental to understanding a company's short-term financial health.
Okay.
And that is the current ratio. The current ratio measures a company's ability to pay off its short-term debts using its current assets.
Okay.
Essentially, it's telling us if they have enough readily available resources to cover their immediate obligations.
So it's like checking if they have enough cash on hand to like pay the bills without having to sell off any of their long-term assets or take on more debt.
Exactly. To calculate the current ratio, we simply divide the current assets by the current liabilities. And in our fictional company, ABC Manufacturing, the guide shows us they have a current ratio of 2.31 to 1, meaning for every dollar of short-term debt they have 2.31 in assets. that could be easily converted to cash.
Okay, so they're in pretty good shape then, right? But what's considered a healthy current ratio? Is there like a magic number that investors look for?
There isn't, there isn't a one-size-fits-all answer.
Right.
A current ratio of 2 to 1 is often considered a good starting point, suggests that a company has a comfortable buffer to meet its short-term obligations.
Okay, so 2 to 1 is like a solid benchmark.
It's a good benchmark, yeah.
But the guide also mentions that the ideal ratio can vary a bit depending on the industry. I'm guessing like a grocery store that's constantly turning over inventory might have a different ideal ratio than, say, a construction company with like longer-term projects.
Company with lots of inventory that takes time to sell, like that construction company.
Yeah,
might need a higher current ratio than a company that primarily provides services and gets paid, more quickly.
Right. Right. Okay, so it's not just about the number itself, but understanding the context.
Exactly.
Okay. Now let's zoom in even closer with a ratio that's even more stringent.
Okay.
And that's the quick ratio, sometimes called the acid test ratio.
The acid test.
That sounds intense. What makes this one different from the current ratio?
Quick ratio takes a more conservative approach.
Okay.
It only factors in the most liquid assets, things like cash, marketable securities, accounts receivable, but it excludes inventory because that can take more time to convert into cash.
So it's like saying if a company had to pay off its debts tomorrow, what could they immediately tap into?
Exactly. The quick ratio helps us to assess a company's ability to handle a sudden financial squeeze.
Yeah.
And in ABC's case, their quick ratio is 1.26 to 1.
Okay. That's a little bit lower than their current ratio, but still above 1. So I'm guessing that's good.
It is. A quick ratio above 1 indicates they have enough readily available assets to cover their short-term liabilities, even if they couldn't sell any inventory right away.
Okay, that's reassuring. Now let's shift gears a little bit and talk about debt.
Okay.
I know in my personal finances, like managing debt is crucial, right?
Absolutely.
How can we use these reports to understand how much debt a company has taken on and if it's manageable for them?
Debt is definitely a key piece of the puzzle.
Yeah.
One of the most commonly used ratios for assessing a company's debt load is the debt-to-equity ratio.
Okay.
This compares the company's total debt to its shareholders' equity.
So it's a way to see like how much of the company's financing is coming from borrowing versus how much is coming from the owners.
Exactly. And to calculate it, you just divide total liabilities by total shareholders' equity. The guide tells us that ABC Manufacturing has a debt-to-equity ratio of 0.93.
Okay, so that means they have 93 cents of debt for every dollar of equity.
Right.
So it sounds like they're using a mix of debt and equity to finance their operations. But how do we know, like, if that's a healthy mix?
That's where things get interesting. The ideal debt-to-equity ratio can vary significantly depending on the industry. A stable utility company with predictable cash flows might be able to handle a much higher debt-to-equity ratio than, say, a tech startup with more volatile earnings.
Right. So a high debt-to-equity ratio isn't always like a bad thing, but it depends on the company's specific situation and the industry.
Exactly. It's also important to consider trends over time.
Okay.
Is the company's debt-to-equity ratio increasing or decreasing? A rising ratio might signal that they're becoming more reliant on debt. Could be a red flag if their earnings aren't growing at a similar pace.
So we need to look at like both the number itself and how it's changing over time.
You got it.
Okay. Now, what about those companies that do have a lot of debt? Are there any other ratios that can help us assess their ability to manage that debt?
Absolutely. The interest coverage ratio is a key one.
Okay.
It measures a company's ability to meet its interest payments using its operating income. Basically, it tells us how much breathing room they have when it comes to making those interest payments.
I'm guessing a higher interest coverage ratio is better then. Like it means they can comfortably make those payments even if their earnings like fluctuate a bit.
You got it. A healthy interest coverage ratio is a good sign that a company can manage its debt load.
Okay.
The guide doesn't actually give us ABC's interest coverage ratio.
Oh, okay.
But it is something that you would definitely want to examine when you're evaluating a company with a lot of debt.
It's like checking to see if they can still make the mortgage payments, even if they have a few unexpected expenses.
Exactly. Now, we've talked a lot about liquidity and debt management, but let's move on to another critical area.
Yeah.
Profitability.
Okay.
Are there specific ratios that can help us see how well a company is turning its revenue into actual profit?
Yeah, that's the bottom line we're all interested in, right?
Right.
Like how do we assess a company's like money-making prowess?
One of the most important profitability ratios is the net profit margin.
Okay.
This measures how much profit a company generates. For every dollar of revenue it brings in, it tells us how efficiently they're converting those sales into actual profit.
So for every $100 worth of like goods they sell, how much are they actually like keeping as profit?
Precisely. The net profit margin is calculated by dividing net income by revenue. In ABC's case, their net profit margin is 6.2%,
Okay.
meaning that they're earning 6.2 cents in profit for every dollar of sales.
Is that a good margin? Like what's considered a healthy net profit margin?
Again, it really depends
Yeah.
on the industry
Right.
and the company's specific circumstances. Some industries, like luxury goods, for example,
Oh, right.
tend to have much higher profit margins than others, like, discount retailers.
Yeah.
But generally speaking, a higher net profit margin indicates a more profitable
Okay.
company.
Okay, so a company with a net profit margin of like 15% is generally doing a better job of controlling costs and generating profit than a company with like a 5% margin.
You're getting it. Now, you might remember, we touched upon return on equity,
Oh, yeah.
or ROE, earlier.
Yeah.
When we were talking about shareholders' equity. It's a crucial metric for investors because it shows how effectively a company is using its shareholders' investments to generate profit.
Right. It's like a measure of how much bang for their buck the shareholders are getting.
Exactly. To calculate ROE, we divide net income by average shareholder equity. And in ABC's case, their ROE is 14.8%, meaning they generated nearly 15 cents of profit for every dollar of shareholder equity.
That sounds pretty impressive.
It is. It's a high ROE is generally a good sign.
Yeah.
But it's important to remember that. It's only part of the story. You also want to look at how that ROE is being generated. Is it sustainable growth? Or are they using like excessive debt or, accounting gimmicks to boost their returns?
So it's like evaluating a basketball player. You don't just look at how many points they score. You also want to see how efficiently they're scoring those points.
Right.
Are they taking good shots or are they just like chucking up threes?
That's a great analogy.
Yeah.
Now, we've covered quite a few ratios today. Current ratio, quick ratio, debt-to-equity ratio, interest coverage ratio, net profit margin, return on equity.
Yeah, my brain's starting to feel a little full.
It's a lot to take in.
Yeah. Is there a way to kind of like simplify all of these ratios and see how they all like fit together?
Absolutely. One helpful way to think about these ratios is to group them into categories based on what they're actually telling us about a company's financial health.
Okay.
We can group them into 4 main areas: liquidity, solvency, profitability, and efficiency.
Okay, that makes sense. It's like organizing our toolbox of like financial detective tools. So remind me what each of those categories tells us.
Liquidity ratios, like the current ratio and quick ratio, tell us about a company's ability to handle those short-term bills. Can they pay their suppliers? Can they pay their employees, their short-term debts without having to scramble? Solvency ratios, like the debt-to-equity ratio and interest coverage ratio, focus more on the long term.
Okay.
Can the company manage its long-term debt obligations?
Yeah.
And stay afloat, over time.
Okay, so liquidity is about like short-term survival and solvency is about like long-term stability.
Exactly. Right. Profitability ratios, like the net profit margin and return on equity.
Yeah.
They're all about the bottom line.
Yeah.
How effectively is the company turning its operations into profit?
Right.
And finally, efficiency ratios.
Yeah.
Which we haven't touched upon yet.
Okay.
Tell us how well a company is using its assets to generate sales. This could include ratios like inventory turnover, which measures how quickly a company is selling its inventory, or asset turnover, which looks at how efficiently they're using their overall assets to generate revenue.
So efficiency is all about like how well they're managing their resources to create sales.
Exactly.
Okay.
And by analyzing these different types of ratios, we can get a much more comprehensive and insightful view of a company's financial health.
Yeah.
And its potential for future success. Like it's like taking a 360-degree view of their financial fitness.
I'm loving this. It's like we're building this like multidimensional picture of the company's performance.
Exactly.
Now, as we've been diving deep into these various ratios and techniques, it's become clear that understanding these financial reports isn't just about, crunching the numbers, but it's about developing that financial intuition that we were talking about earlier.
Absolutely. It's about learning to ask the right questions, to connect the dots between different pieces of information, and to develop a feel for what's normal and what might be, red flag.
So it's like being a financial detective looking for like clues and patterns that can help us solve the mystery.
That's right.
Of a company's financial performance. And one of the best ways to develop this financial intuition is to practice, right? Like to look at real world financial reports.
That's right.
And start applying all of these techniques and ratios that we've been talking about. The more you do it, the more comfortable and confident you'll become.
You'll get better at it. Absolutely.
Okay, so practice makes perfect.
Yeah.
Now, I know we can't cover every single ratio and technique in this deep dive.
Right.
But I feel like we already learned so much. What are some of the key takeaways you want our listeners to like walk away with from this part of the discussion?
I think the most important takeaway is that these ratios are not just abstract numbers. They tell a story about a company's financial health and its potential for future success.
It's like we're learning to read the language of business.
Exactly. And by learning that language, we can make
more informed decisions, right?
About our investments.
Absolutely.
And about our own personal finances.
I'm feeling empowered. So what's next on our little financial adventure here?
In the final section, we'll take everything that we've learned and apply it to some real-world scenarios.
Oh, cool.
We'll put on our, our detective hats.
Yeah.
We'll analyze some hypothetical case studies, and we'll see how these ratios and techniques can actually help us to make smarter investment decisions.
Ooh, I love a good case study. Let's crack the case. All right, detective partner, we've got our financial magnifying glasses and a whole arsenal of ratios at our disposal. I'm ready to put these tools to work and solve some real-world investment mysteries.
I knew you were a natural at this.
Yeah.
So in this final section, let's tackle some case studies and see how we can use everything we've learned from the Merrill Lynch Guide to Understanding Financial Reports to actually make some smarter investment choices.
Okay, love it. First case. Imagine we're looking at two companies in the same industry. Let's say they're both streaming services battling for subscribers.
Okay.
On the surface, their revenue and earnings numbers look pretty similar. Where do we even start digging deeper to see which one might be the stronger investment?
The balance sheet is always a great place to start.
Okay.
We can compare their liquidity ratios. Remember, those tell us about a company's ability to meet its short-term obligations. Let's say company A has a current ratio of 2.5 to 1.
Okay.
Well, company B has a current ratio of 1.5 to 1.
Okay, so company A has a higher current ratio, meaning they have more assets that can easily turn into cash to cover their short-term debts. So that's like 0.1 for company A.
Right. But hold on, I remember you saying that we shouldn't rely on just one ratio in isolation. What if we look at their quick ratios?
You're thinking like a pro. Remember, the quick ratio is even more conservative because it excludes inventory from the equation. Let's say company A's quick ratio is 1.2 to 1.
Okay.
While company B's quick ratio is 0.8 to 1.
Interesting. So even though company A initially looked better with that higher current ratio, their quick ratio is actually closer to company B's. I'm sensing a little plot twist here.
Yeah.
What could be going on? It could indicate that a big chunk of company A's current assets is actually tied up in inventory. Maybe they overestimated demand for their, for those streaming devices they sell. And inventory can take a while to turn into cash, which could be a problem if they need, quick access to funds.
So a high current ratio isn't always a guarantee of smooth sailing. We really need to look at the composition of those current assets as well. Okay, let's move on to debt. How do we use those financial reports to determine which company's kind of handling their debt more effectively?
The debt-to-equity ratio can give us some valuable clues there. Remember, it compares a company's total debt to its shareholder equity. A lower ratio generally means the company is less reliant on borrowing to finance its operations, which can be a good thing.
Right. So if company A has a debt to equity ratio of zero point 0.5 and company B has a ratio of 1.2, what's the verdict?
Well, on the surface, Company A appears to be in a stronger position. They have uh, significantly less debt relative to their equity than Company B. This suggests that they're less vulnerable to to interest rate hikes or economic downturns. That could make it harder to service their debt.
Okay, so company A is looking pretty good so far. Strong liquidity, healthy debt to equity ratio. But what about the most important factor, profitability? How do
Mhm.
we determine which of these streaming giants is actually better at raking in the cash?
That's where those profitability ratios take center stage.
Okay.
Let's compare their net profit margins and return on equity. Suppose Company A has a net profit margin of 8%
Okay.
and an ROE of 12%, while Company B has a net profit margin of 10%
Okay.
and an ROE of 15%.
Hold on. Now, company B is in the lead when it comes to profitability, but I thought company A seemed less risky with their lower debt. How do we reconcile these seemingly conflicting clues?
This highlights a really crucial point. Sometimes a company that takes on more debt can actually generate higher returns, at least in the short term. It's a classic trade-off between risk and reward.
So company B might be the more dynamic and potentially more rewarding investment,
It could be.
but it's also kind of playing a riskier game.
That's right. And the best choice for an investor really depends on their own individual risk tolerance and investment goals. If you're looking for potentially higher returns, but you're comfortable with more volatility, Company B might be appealing. But if you prioritize stability and a lower risk profile, then Company A might be the better fit.
This case study really highlights the importance of considering multiple factors and understanding the interplay between these different ratios. It's like assembling a puzzle. Each piece gives us a different perspective, and it's only when we put them all together that we can really see the whole picture.
That's a great way to put it. Financial reports are they're like stories waiting to be decoded.
Mm-hmm.
And it's our job as investors
Yeah.
to to read between the lines
Yeah.
and understand all those nuances.
Now, one last question before we wrapped up this financial detective adventure. You mentioned earlier that it's important to look beyond just the numbers and consider some qualitative factors as well. What are some examples of those, and how can we even begin to evaluate them?
Qualitative factors are
Like,
those aspects of a company
Yeah, that-
that are harder to quantify,
yeah.
but can have a huge impact on their long-term success. Things like the quality of their management team,
Oh, okay.
their brand reputation,
Right.
the competitive landscape of their industry. Those are all vital pieces of the puzzle.
So in the case of our streaming services, we might consider which one has a more innovative CEO, or which one's better at creating buzzworthy content.
Exactly. You might also look at at their environmental, social, and governance practices.
ESG.
Their ESG practices, right?
Yeah.
Consumers are becoming more and more conscious of these factors, and companies with strong ESG ratings might have a real competitive advantage in the long run.
Okay, so it's about understanding the company's overall story, its values, its vision for the future. But how do we actually assess those qualitative factors? It seems a little more subjective than analyzing a debt to equity ratio.
You're right. It does require a bit more digging, a bit more intuition. You can read industry reports, you can follow news coverage, you can research the backgrounds of the management team, you can even look at third-party ratings on things like environmental sustainability and corporate governance.
So it's like being a journalist, kind of gathering information from various sources to form a well-rounded perspective.
Exactly. And remember, investing always involves a, a degree of uncertainty.
Yeah.
But by arming ourselves with knowledge, by developing that financial intuition.
Yeah.
And by considering, both the numbers and the story behind those numbers, we can make more informed and more confident decisions.
Absolutely. Well, this deep dive has been an incredible journey. I feel like we've cracked the code of financial reports and gained a whole new level of understanding.
It's been a pleasure sharing this journey with you. And remember, the key is to stay curious.
Yeah.
Keep learning.
Yeah.
And never stop asking questions. The world of finance is constantly evolving, and there's always more to discover.
I'm definitely feeling more empowered to navigate the financial landscape and make some smarter investment decisions.
That's great to hear.
Thanks for being the perfect guide on this little financial adventure.
My pleasure.
And to our listeners, thanks for joining us on The Deep Dive. We'll see you next time for another deep dive into a